Now let's talk about the different types of stocks. The most common types of stocks are common stocks and preferred stocks. Preferred stocks have lesser rights compared to common stocks, but when it comes to dividend payments, most preferred stocks will have priority in receiving them, even if common stocks do not receive a dividend. So dividend-focused investors will sometimes find these more attractive because of a guarantee of dividend payments, and these payments are often higher than they would be for common stocks. As beginners, we want to steer clear of these stocks because they are much more complex in nature, and each company handles them differently, and they aren't as liquid or even behave in the same manner as common stocks. So most of us will be investing in common stocks, the majority of stocks that individuals like ourselves buy and sell in the market. Common stocks have voting rights in shareholders' meetings, and they also have the right to receive dividends, but only after preferred shareholders have been paid. And again, this is on a company-by-company basis. Every company does it a little differently, which makes preferred stocks complicated. Both of them do have liquidity, though. And a major advantage of common stocks is they have much higher liquidity than most preferred stocks. This means that there is an active market for the asset. If you're holding stocks of companies that trade frequently, you can easily find opportunities to sell at reasonable, profitable prices. However, if we held shares of more obscure companies, smaller companies, one with less trading volume per day, namely, in this example, some preferred stocks, you might find that your ability to trade or liquidate them when you want to sell them is greatly inhibited because there's not enough volume. There's just not enough people looking at those types of stocks because everyone's trading with larger companies, or they're looking at common stocks instead of preferred stocks. So it's always advisable to hold stocks of companies that trade nearly every day in considerable volumes. Otherwise, we can find ourselves stuck with a stock that nobody else wants to buy. Next, we're going to talk about shareholder income, cash dividends, buybacks, bonus shares, and stock splits. So this is all the things companies can do to and with the stock to essentially provide value to their shareholders. So this is how the company can help make you a better return on your investment. And dividend payments that occur when companies have excess profits. The most common form of dividends is a cash payment, and these are simply called cash dividends because the company simply just divides the cash among shareholders and gives it to them. Then we have companies. Sometimes companies offer their shareholders excess profits from multiple years, and this can sometimes happen with preferred stocks where they might not pay a dividend for a year or two, and then all of a sudden they'll pay a big dividend. So that's sometimes what can happen with cash dividends as well. If a company decides to hold on to profits and reinvest them in the business for expansion, development, or growth, it's called retained earnings, and that's retaining the earnings. They're keeping the earnings instead of distributing them as dividends. Normally, large, well-known companies announce dividends along with their quarterly results, while many others issue dividends on a semi-annual or annual basis. And most dividends payments are in cash, just paid directly to you. Also, some companies allow you to take that cash dividend and automatically buy more shares. That's a little more advanced and changes with the broker that you use. The amount a shareholder receives with a dividend will depend on how many shares they own divided by what's announced by the company. And this is simply saying you have a proportionate share. Your proportionate share of whatever earnings are distributed is based on how much stock you own. So if you owned 10%, you would get 10% of whatever the total dividend pile was. Oh, and like I said earlier, jumped ahead of myself, many companies do offer dividend reinvestment plans, where instead of receiving cash, investors can opt to automatically buy more stock with their dividend payments. This can prove to be more profitable if you do not need immediate cash, because it can allow you to build your investment portfolio much more quickly. Next, we have buybacks. Well, cash dividends are the most common form. Companies can also engage in buybacks, where they buy back stock on the open market to decrease the supply of their stock. This helps stockholders because the decrease in supply tends to increase the price of the stock. Less stock available, the higher the price becomes, generally. Next, we have bonus shares. And this is another non-cash dividend practice corporations engage in offering a way for profit for shareholders. And these shares are offered to current shareholders on the basis of the number of shares that they already hold. So even though bonus shares do boost the total number of shares that the company has issued, the value of the company will not normally change by the issue. Another important point to understand is, in spite of the increase of the total number of shares outstanding, the ratio of shareholders will not change. They're simply giving more shares to current shareholders. Normally, only certain classes of shares are entitled to receive bonus shares issues, so this is where preferred stock versus common stock comes into play, and a higher preference to receive different classes of stock. Finally, we have stock splits. A stock split also increases in the number of shares issued by the company. However, the price of the stock split is adjusted in such a manner that the market capitalization value, the total value of all stocks outstanding, does not change, and there's no dilution in people's ownership. So here's what all that mumbo jumbo means. Stock splits can be in different ratios, such as 2 shares for 1, or 3 shares for 1, or 3 shares for 2. But we'll stick for 2 to 1 because that's the most common. Companies usually resort to stock splits when the price of a stock has risen substantially, so they use the split to bring it back down. So here's the example. If a share is quoted at $50 in the market, and if the company announces a 2-for-1 split, the value of each share will get adjusted to $25 because the number of shares outstanding has doubled. So let's say there's 500 shares in the market and they're all trading at $50 a share. When they announce a 2-for-1 split, what they're doing is they're splitting each stock into 2. So instead of 500 outstanding, now we're going to have 1,000 outstanding. But the total value of those stocks doesn't change. They're just cutting it in half. So instead of being 500 shares at $50, it's 1,000 shares at $25. So you can see they're just doubling the number of shares, but they're not messing with what the stock is actually worth. All right, now we're going to get into reasons companies issue stocks. The first time a company issues a stock in the general market, it's called an initial public offering, or IPO for short, and you'll hear IPO a lot. Companies do this primarily to raise money for the business, and here's some more common reasons companies issue stock. Raising additional capital for a recent business expansion or a new development, for developing new products, building new factories, purchasing the latest machinery, hiring more employees as part of a business expansion, for acquiring or merging with other companies, reducing existing debts, so issuing more stock to pay their debtors, to enhance the value of the company, and finally to provide greater flexibility to current company owners and managers. Getting the information you need. With more than 8,000 companies listed across the American exchanges, ticker symbols are used to easily identify companies and investment products. A ticker symbol can be anywhere from 2 to 4, sometimes 5 characters to identify a stock, index, or fund. Every stock has a unique ticker symbol that acts as an identifier of that company's stock. Some characters or lengths in tickers have significance based upon the type of stock or fund it represents. For example, if a stock has 4 characters, it means it's listed on the NASDAQ, while ones with 3 are listed on the New York Stock Exchange. The best place to find free financial information is Yahoo Finance. In most instances, these free sites, like Yahoo Finance, which is still my top one for over a decade, will provide you with more than enough information to make an educated investment decision. If you're looking to be a trader, you will have to pay for real-time information or choose a broker that provides you free real-time information if you make a certain number of trades per month or per quarter. But for investors, receiving delayed market data really isn't an issue, which is why I pretty much stick with Yahoo Finance and I don't worry about trying to pay for live quotes. All right, so we're coming to the end of Module 1, and I wanted to wrap up with some additional learning resources for you, because it's very difficult to present all the terminologies and their meanings related to the stock market here, since there are over 8,000 terms and definitions. That being said, I've done my best to present the most important parts, and hopefully this module has answered some, if not most, of your basic questions. If you have any questions or suggestions for future videos or future content updates, please leave a comment in the comment section. I do read it. As you continue to learn and increase your financial education, I've included some helpful links below in the description. Investopedia is a great resource for investing and trading definitions. I still use it to this day. So if you ever need to look up what a word means, this should be your go-to source. Also, shameless plug, thewealthtitans.com has a great selection of free training modules and blog posts. And be sure to subscribe to my YouTube channel here for weekly insights so you can continue to improve your investing results. So thank you again for watching. I hope you found this informative and actionable. This concludes Module 1 of the Stock Market Foundations course. If you have any questions or comments, please just drop your thoughts in the comments section below. And don't forget to check out my YouTube channel and subscribe so you can stay up to date with the latest investment insights. And I'll see you in the next module to your investment success.